Hello. Thank you for joining us for this May 17th, 2024 edition of FedWatch. I'm Brian Beaulieu. A lot of data came out this week, and I'll tell you the summary right up front. The economy isn't as strong as some of the headlines make it out to be. Inflation remains problematic, but the economy is slowly softening. And I mentioned the headlines because I was looking at the BBC this morning, and one of their headlines was, "Is the U.S. economy too strong?" Well, it's probably too strong for Britain's sake, but it isn't too strong from a domestic perspective. And we saw mortgage rates come down, which is good, but that's not a sign of strength. That's a sign of relative softening in the marketplace also. So let's look at some of the data, see what the tidbits mean. PPI for April came out, and that showed modest strengthening. The 112 increased to 2.1%. That's phase B now. It's not a problem at 2.1%. What's the problem? And this is the ongoing story, right? The service sector of the producer price index, the services aspect, continues to fuel that rate of inflation. The goods rose, but not as much as the services. And within the goods, it was energy that accounted for most of the increase. Food pricing declined, as a matter of fact. So it's energy, which is a problem for consumers. And the overall PPI went up, which could be a problem for the Fed. CPI, however, for April showed a modicum of improvement. There, the 112 rate of change eased a little bit down to 3.4%. It had been 3.5%. But we're seeing the same old song and dance. Most of the increase, 70% of the increase, as a matter of fact, was because of shelter and gasoline in particular. Shelter is at 5.5% on a year-over-year basis. It's in a gradual phase C, so disinflation mode, but it's taken its sweet time to come down. Core inflation eased to 3.6%, and that was noticeable. It had been at 3.8%. So at least it's moving in the right direction. We can take some comfort in that. It's the service sector. The service sector CPI, the services CPI is at 5.3%. And it's not really coming down. It seems to be stuck at about that level. And that could give us all heartburn if we are pulling for interest rate decline. It's noteworthy that while the CPI core even remains stuck at a relatively high level, too high a level, really. The durable goods side of it is at minus 3.2% year over year comparison, and that's the lowest rate of 112, so the lowest amplitude, the most deflation we've seen in just about 20 years. So the goods side of it is doing what it's supposed to. It's just the nasty services side. On retail sales, and this is part of what I was mentioning when I said that we're going to see a little bit of a slowing down, I think, in the overall economy. The seasonal rise that began in April was barely normal. The rates of change, and you'll see this in the ITR trends report, the rates of change moved up, but that's largely because of what we call reciprocal pressure. Last year was weak in April. It could be for a whole host of reasons, but the current movement in the data is barely considered normal. It's well below average, as a matter of fact. Housing starts, I looked at single family housing starts. That data came out this week, and that 312 rate of change has tentatively reversed direction, setting March as a high. And our analysis suggests that it is going to hold as a high. And we're going to see that means the data trend levels off in housing 4Q this year, 1Q 2025. We don't think there's going to be a recession per se in housing, but we're going to lose some of this upward momentum, and that's consistent with the forecast that we've been showing you in the ITR trends report. And as I mentioned, those mortgage rates have come down. What does this all mean for us? That slowing in the economy is going to continue, and part of what makes us say that is we created this series looking at savings, consumer savings adjusted for inflation. And that's down about 0.2% from last year. It's been essentially flatlining on this for the last 20 months. And over the last 3 months, it's actually shown some decay, noticeable decay. So we're going to be keeping a close eye on that. If We're seeing a slowdown in real personal income going up. At the same time, the savings are being drawn down. It's logical to assume that we're going to get some more softening in retail sales, or at least a soft seasonal rising trend. We still think we're going to get some interest rate decline in the second half of this year in those short-term interest rates, but I don't think we're going to see it before the third quarter. Now, there's a great way to watch, or literally watch or listen to all of these indicators that I talk about in greater detail, and that's through By the Numbers. It's a new service that we're offering. It's $30 a month. We have one of our senior economists meeting with our host, Lindsay Warnham, and together, Lauren and Lindsay digest 4 to 6 topics each week about what you need to know in a very conversational, business-friendly manner. Check it out. You can go on our website and look at some previews. It's called By the Numbers. And at $30 a month, it might be an easy way for you to keep on track with more analysis along the lines of what we just talked about. Thanks for joining us for this edition of FedWatch. See you next week.